Hey everybody, this is Greg Gossett from Gossett Trading, and today is Saturday, November 25th, 2023. Hope you're doing well. Hope you had a nice Thanksgiving, enjoyed that with your families, or enjoyed it wherever you were. I appreciate you coming to my weekend review podcast. The format for today, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily and the weekly time frames. We're going to talk about when I entered the trade, why I entered the trade, what was the strategy, what was the setup, and then most importantly, how I am going to manage the trade going forward, either to the upside or to the downside. You know, in trading, all we can do is be patient, wait for a proper setup, position size properly based upon the volatility of the market, and ideally having a good risk to reward ratio at a significant level of support, and put the trade on, know what we're going to do regardless of whether the trade goes up, goes down. The way that I do it, I look for major support, 30 RSI, 300-day moving average, 250-day moving average, 200-day moving average. One of those two. These are for deep dip buy stock trading strategy. But looking for that resistance, looking for the for that support, looking for the market to tell us that, you know, there are no more sellers underneath this level, and therefore take the trade, place the emergency stop, have a good risk to reward ratio on your end of day stop, and then as it moves up, I take partial profits. If it gets to a certain level, 1.5 ATRs above my entry, then I tighten it up even more with where I go into trailing stop mode. But these are all the things that I'm going to show you today on the trades. Okay, and so after we go through the trades and how they're doing, we're going to do a little bit on trader psychology. Always the most important part, most important skill in trading is the ability to create a plan and then follow that plan. You know, it's important that you do use a process that incorporates good trading principles, and you have to do that. You really have to do that in order to be successful at trading. But most importantly, back to the trader psychology, you have to follow the process. You could have the best trading process in the world, but if you don't follow it, what good is it, right? So after that, I have gone down through my watch list, both on the daily and the weekly time frames. And I've gone down through and I have identified some potential trades that I will be interested in next week, both on the daily and the weekly. You know, with this rally that we've had, this basic historic rally that we've had, I do have some shorts that I'm looking at for next week. We're getting into some pretty significant overhead resistance and some order blocks and some fair value gaps. So I'll have more shorts than usual here today, but I also do have some potential longs as well. All right, so that's going to be the format. Hope it's going to be helpful for you. Hope you're going to learn something that is valuable. And so to get started, I have to run the U.S. legal disclaimer, and I will be back in about 40 seconds. So hang tight, please.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started on the daily trades that I took, or that I have been in. Let's see, this is SPY, going all the way back to October 30th, 2023. This is when I entered the trade. At the beginning of the podcast, I talked about being patient, waiting for levels to be rejected to the downside. And I do want to say right now, the best trade setups are the ones where you have multiple combinations and confluences of signals lining up at the same time. So let's take our attention back to when I bought this on the 30th of October. Why? Well, we'd had quite a large sell-off here actually. And then you see the orange line here. This is the 300-day moving average. This is a significant level of support. And on the day before I bought it, it closed under the 300-day moving average. You see this? And then the next day it closed over the 300-day moving average. That by itself is a legitimate deep dip buy setup, but combinations of setups are even better. And the previous day before I bought it, it closed below a 30 RSI and then also closed above the 30 RSI. That by itself is also a legitimate entry. But we had the two together, the close under 30, close over 30. The close under the 300, the close over the 300. That is a confluence of signals. Doesn't mean it's going to be a winning trade, but it does improve your chances of having a profitable trade. So as soon as I have my confluence of signals, I say, okay, I'm going to go ahead and buy. But the key question is, how much do I buy? I always talk about position sizing based upon the volatility, and I'll show you how to do that now. So it's based upon your total capital. And a good rule of thumb is your maximum allowed risk for a trade, 1%. So let's take a hypothetical $100,000 trading account. 1% of 100,000 is $1,000. If you had a $50,000 trading account, 1% would be $500. If you had $1 million trading account, 1% would be $10,000. So let's use the hypothetical $100,000 account. Times 1% is $1,000. I would take that, divide that by the value of the 2 ATR. Currently, right now, the value of 2 ATR is 865. It wasn't that back here, but let's just say it was 1,000 divided by 8.65. It would tell me to buy 115.6 shares. I would just round that up to 116 shares. So I'm buying 116,000 shares. Now, the first move that I make is I place my emergency stop. The emergency stop is, in this example, $8.65. So I take my entry minus $8.65. That is now my emergency stop. So if I have 116 shares and it moves $8.65, there's my $1,000 loss. That's my maximum allowed loss that I'll take on that trade. And that's 2 ATRs below. That's 2 average true range below my entry. So the chances of it going down here are very low, only about 5%. 95% of the time, if you have a loss, it's going to be your end of day stop. So we have the emergency stop. You get out of that regardless. For my end of day stops, I wait till the end of the day to make my decision. Before my emergency stops, if it ever gets there, regardless of just 1 minute after the market opens or 1 minute before the market closes or anywhere in between, if it gets there, then I am out. I've lost my $1,000. That's the maximum I've allowed that I've lost on a trade. But again, this only happens about 5% of the time. The other 95% of the time is end of day stop. Well, the under 300 to over 300 is why I took the trade. So in the future, if it had just closed even 1 penny below the 300-day moving average, I would have just gotten out of the trade. That's it, right? So, so after I wait for the signal, after I position size, I know what my emergency stop is. I know where my end of day stop is. Then what I do is I put a trailing stop level 1.5 ATRs above my entry. Remember, we put the emergency stop 2 ATRs below. But if price gets 1.5 ATRs above, then I go into what is called trailing stop mode because it's moved a pretty decent amount, and now I want to tighten up my stop. And so all that means is if I get to 1.5 ATR trailing stop level, then I have a close below a previous bar's low, then I exit half. Now, these are all defensive moves. The position sizing, the emergency stop, the end of day stop, the trailing stop level, these are all defensive moves. But I also need to play offense on trading. And offense means I take partial profits as it moves up. And it's quite simple, actually. I always take the previous day's close. So here we are on the SPY, 455.26. So 455.26. Then I look for the value of the 0.45. Right now it is $1.95. So I take the closing price of the day, add 195 to it. $457.21 is my first profit target for Monday. Then I take the first profit target, 457.21. I add the 0.45 to it again, plus 1.95. Second profit, 459.16. Take the second profit target, 459.16, add $1.95 to it again. That's my third profit target. So those three profit targets, I'm just going to put in the system as limit orders for Monday. Will I hit all three of them? I don't know. Probably not. Will I hit one of them? Maybe. But then the question is, well, how much do I take off? I always take off 10% of whatever shares I have remaining. So if I had 1,000 shares down here, and the next day after I took the trade, I hit three profit targets, I'd take off 100, 100, 100. So that would leave me with 700. So the next day, if I had three profit targets, I'd have 70 and 70 and 70, and so on. So that's kind of the basics here. And I just want to point out right now that this is a deep dip buy stock trading strategy. I trade 5 different strategies. And if you're new to this channel, you might look at this and go, boy, there's a lot of rules there. I don't know if I could remember all that. But I just want to remind everybody that I do teach private one-on-one lessons in the evening time via Skype. I've taught for years. I have taught people from all over the world, from absolute beginners to seasoned hedge fund managers. So if you're interested in learning to trade like I do, learning all the rules and having a one-on-one instructor that will teach you all the rules of all the 5 different trading strategies, I think I'm your guy. And I love to teach. My students have been very happy with the course. And so if you are interested, all you have to do is send me an email. The email is in the link of this YouTube video, and we can have a discussion. And it's a great skill to learn. It really is. I've been trading for 28 years now, if you can believe that. And so what I teach in my course is 28 years of experience, 5 great trading strategies that use all the trading principles that you really need to know to be a successful trader. All right. So anyway, just want to put that out there. I'll touch on it a little bit at the end. So back to the position now. So just kind of a recap. Confluence combinations of indicators. Under 30, over 30. Under the 300, over the 300. Position size correctly based upon volatility. Place your emergency stop. I know where my end of day stop is. I know where my trailing stop level is. And so once I took the trade, position size, next day moved up, not enough to take any profits, didn't hit a profit target. Next day moved up significantly. I believe I hit 2 profit targets. Next day moved up again significantly. I hit 2 or 3, can't remember, it's been a while. But at this point, I hit trailing stop level, which means now if I have a close below a previous bar's low, I'm going to exit half of the position. So then we had these 3-4 days here that kind of dripped up a little bit, no profit targets, didn't move up enough. But then here on the 9th, I had a close below a previous bar's low. After reaching trailing stop level, I exited half of the remaining position that I had for a gain of 4.38%. This is a precautionary move because this is the first time the market showed that it was weak enough to close below previous bar's low. So I took half off. Taking half is one of the best things you can do. It's a win-win situation because if it went all the way back down, I'm happy that I sold half. If it moves up from there, I'm happy that I still have half. Makes sense? So the first action that I had to take was a close below a previous bar's low after reaching trailing stop level for a gain of 4.38%. And then it continued to move up. I continued to take profit targets here, 10% of whatever shares I had remaining. Next day didn't do anything. Next day moved up significantly took 3 profit targets off. So do you see how I'm reducing and reducing and reducing my position up here? Market can't take that away from me, and it tightens up. It's like having a tighter and tighter and tighter trailing stop level because you're selling more and more shares. Now here on this particular day, and again, this is one of the rules that I teach in my course, but here on this day, we went above the 70 RSI and then closed below the 70 RSI. 92% of prices stop going up, move sideways, or go down when you reject the 70 RSI. So here with the rejection of the 70 RSI, it made sense. So I took off another half of whatever I had remaining. So I took another quarter off for a gain of 7.7%. Next couple of days, we moved sideways, no profit targets. On the 20th of September, we had another surge up where I took some more profits off. Next day, inside bar. Next day, moved up again, took some more profit targets. So at this point, I'm whittling and whittling and whittling and whittling my position down, and the remaining shares that I have on this particular trade currently up 8.85%. So I hope that was helpful. This is a good example of using a lot of different rules, trailing stop rules, rejections of 70s. And by the way, in the future now, because I've rejected the 70 RSI, if in any day in the future, very easy, if I have a close below a previous bar's low, just out of the trade. So there you go. Sold half, 4.38%. Sold a quarter, 7.7%. And the remaining shares I have up 8.85%. So really, really good trade. Caterpillar. All right. I took a lot of time on that SPY there just to try to lay out some of the rules. So I'll be a little quicker on here, but here we go. I entered Caterpillar on the 1st of November. Why? Well, confluence of signals again. Close under 30, close over 30, close under the 300 SMA, close over the 300 SMA. I position size, place my emergency stop. My end of day stop was the main reason I took the trade because we had to close under, over the 300. My risk to reward ratio was very good here. So the next day, if it had just closed below the 300, I simply would have been out for a small loss. I mean, the maximum allowed loss I would have would be 1%, right? So if it just closed a penny below, it would be a very, very small loss. So confluence of signals, position size, I know where my emergency stop is. I know where my end of day stop is. Place my 1.5 ATR trailing stop above my entry. Next day, moved up nicely, took some profits off. Next day, got to trailing stop level, took another profit target off there, by the way. Now I'm in trailing stop mode, so if I have a close below previous bar's low, I get out of half. Here, it barely closed above the previous bar's low, so it kept me in the trade. Next day came down, did close below the previous bar's low. I sold half of the remaining shares that I had at 1.31% profit. Next day, the next few days, moved sideways, although I did hit a profit target here. I did hit a profit target here, but it's holding my 300-day moving average stop. Next day moved up. Next day moved up. More profit targets. Next day moved up. More profit targets. Here on the 17th, had more profit targets. Now we've had a little bit of a down move. But so the remaining shares that I have on Caterpillar currently up 6.38%. Pretty good. Google. All right, this was a short, and you see this bar right here, and this is kind of complex, so I'm not going to go into the entire strategy because I really don't have enough time. But this is called an order block. Here we had a nice big up bar, and then the market structure changed to a bearish market structure. So if the price comes back up anywhere between the low of this order block and the high of this order block, that is a short. So on Thursday, you can see we did get into this order block. I got short here, 138.70. I position sized. I placed my emergency stop 2 ATRs below. My end of day stop is just a close above the high of this order block. And so I position size, emergency stop above, 1.5 ATR trailing stop level below. So if I get down to that, then I go into trailing stop mode. And because this is a short, if I have a close above a previous bar's close, I get out of half. So hope that makes sense. So my end of day stop is simply a close above 139.36. It did move down on Friday for me, and the current position or the current profit on this short trade currently up 1.46%. All right. So the thing I want to point out here, the last three positions that I showed you were positive positions. And it's a very important concept in trading to be very patient with your winners and be very impatient with your losers. Now, SPY, back to SPY. I bought this on October 30th. I've been in this trade a long time. Why have I been in this trade a long time? Because it's been a profitable trade, right? I've been in it, what, a month, almost a month, or almost a month. Caterpillar, profitable trade. Been in this a long time as well. Why? Because I'm patient with my winners. Google, well, I just got in one day ago, but as long as it's going down, I'm going to stay in it. Now, these are a couple losing trades, but you'll see they're losing trades, and you're always going to have losing trades. But when you're wrong, you have to get out quickly. A lot of traders stay in losing trades a long time, and they stay in winning trades a very short period of time. And it's exactly opposite of what you should do. When you're wrong, be wrong quick, and you'll see a lot of trades that I have that are losing trades are I'm in it one day. I took a long position on VIX on the 22nd of November. Why? Well, it was a good confluence of signals. We had an under 30, over 30, and we had a V1 entry signal. And by the way, if you'd like to learn more about V1 entry signals or V2 entry signals, I have a video on my YouTube channel called V1, V2 entries. They're a really large part of my trading. Go and watch that video. It's totally free, and I think it will be helpful for you. So the confluence of signal on this particular trade was an under 30, over 30, plus a V1. Now, this didn't work out, but the point I'm trying to make here is that it didn't work out. I'm just out. Right? So I got long here, 1814 on the confluence of signals. I position size, I placed my emergency stop. The main signal that I took to get in this trade was the intraday rejection of the 30 RSI. So therefore, in the future, if it closed below 30 RSI, I'm simply out. You can see I put my 1.5 ATR trailing stop level here. And we were above 30 on Thursday or Wednesday. Friday, look, 28.98. Did it close below 30 RSI? It sure did. So I'm just simply out. 3.13% loss on this trade, but it's fine. But the main point, when I'm wrong, I get out quick. When I'm right, I stay in the trade. And I would suggest that you would consider doing something similar to that, because big picture wise, you have to be patient with your winners and you have to be impatient with your losers. So the under 30, over 30 plus the V1 was a legitimate entry position, but very next day out. And if you look at the records of any good traders, you will see that they let their winners run. They have a process that lets them know what to do with their winners. But when they're wrong very, very quickly. And again, that's what I teach in my one-on-one program. So loss of 3.13%, it's under 30 RSI. Look, if this closes back above 30 RSI, I will consider taking it again. But if it just keeps on moving down, I'm really glad I'm out of the trade. Here's another example of a losing trade that was a very, very quick trade. Okay, this is on DIA. Here was the order block all the way back here on 9/14. I took the trade because it was in the order block area. I got short 349.70. I position size. I placed my emergency stop 2 ATRs Above, I have my 1.5 ATR trailing stop level here, but my stop is simply a close above this order block at 350.63. Well, the next day it closed above, and I'm simply out. Had a small loss of 0.58%. But you can see the two losing trades that I'm showing you today, or on this podcast today, I took them. They were legitimate signals. They just didn't work, and I'm out quickly. And am I glad that I got out so far on this diamond trade? Sure, because look, it's much, much higher. All right. So, review of the dailies. SPY remaining shares up 8.85%. Caterpillar remaining shares up 6.38%. The Google short up 1.46%. The losing trades VIX down 3.13%. And the diamond trade small loss of 0.58%. But if I'm doing my job correctly as a trader, my winners are going to be much larger than my losers. And you can see the VIX trade, it's fairly substantial, 3.13%. But still, if you compare that to the SPY and the CAT and Google, you'll see that the losers overall, less than the winners, and that's the key to trading. All right, let's go over to the weekly bars. Now, weekly bars are taken on Fridays because that's when the weekly bar closes. So I bought gold all the way back here on 10/6, October 6th. Well, if I'm still in the trade on November 25th, does that mean I have a winning trade or a losing trade? It means I have a winning trade. There's no way I'm going to stay in this trade if it's this long if it was a losing trade. So why did I take the trade? Well, 200-day moving average. Major level of support. Also rejected the negative third ATR channel. So during the week, we went under the 200, closed above the 200. We went below the negative third ATR channel, closed above the third ATR channel. I position size, I placed my emergency stop 2 ATRs below. My end of week stop on this one is the opposite of why did I take the trade? I took the trade because it intra-week rejected the 200-day moving average. Therefore, if the next week it had just closed below the 200, I'd simply be out, right? Placed my 1.5 ATR trailing stop level here, got in 169.70. Next week, big monster move up. I definitely hit 2 profit targets, possibly 3. That's the offensive part, selling into strength. Obviously got to my 1.5 ATR trailing stop level. So now if I have a closing bar below a previous bar's low, I get out of half. Next week, again, surge up, took more profit targets. Next week, moved up again, hit 1 profit target. Next week, moved sideways. And then this week here, I had my first close below a previous bar's low. After reaching trailing stop level, I got out of half for a gain of 5.71%. Precautionary move because it started to move down. But then next week, right back up again and took more profit targets off. And then this week up here, it did move enough to move 0.45 ATRs with another profit target. So amazing trade, amazing example of a very, very good risk to reward ratio. That if I'm wrong, I'm probably wrong small. The worst I can do is lose 1%, right? But most likely much less than that if it would have closed below the 200. And this particular trade, or on the remaining shares that I have, up 8.46%. Last but not least, XLF. I have been talking about this for months and months and months. What does that mean? Well, it means that it's been a positive trade. I got into this, folks, all the way back March of 2024. Why? 250-week moving average. During the week, it went under, closed back over. I got long here, 30.71. I position size correctly, put my emergency stop 2 ATRs below, put my 1.5 ATR trailing stop above, and then next week moved up, took some profits. Next week, nothing. Next week, took some profits. Got to trailing stop level. Now, if I have a close below a previous bar's low, I get out of half. We never had a close below a previous bar's low. Then we moved up, took some profits targets here. And then here, was the first close below a previous bar's low. I took half off for a gain of 6.4%. Then we moved up again, more profit targets here, more profit targets here. I'm continuing to reduce my position size. And then we had this 2.5 month down move, down move, down move, down move, down move. Here on this week, if we would have closed below this 250-week moving average, I would have been out, right? Because that's why I took the trade in the first place. But it went below, closed right back above, kept me in the trade, and then had a monster move up, took some more profits. Next week, nothing. Next week, move up again, more profit targets, and then this week did hit another profit target. So the remaining shares that I have on this particular trade up 13.07%. But the key point here, everyone, is that you have a process. You know when to take profits. You know when to get out. You know when to hit your trailing stop mode. That you have a roadmap of what you want to do instead of just going, I'm just going to get out here because I feel like it. It's a much more holistic way to trade, everyone, if you just follow a process. But the process has to be based upon good trading principles, position sizing, good risk to rewards, taking partial profits, knowing when to go into trailing stop mode, knowing what to do when you're above 65 RSI, knowing what to do when you get up to the 70 RSIs. And again, this is what I teach in my one-on-one course. So there you go. Gold on the weeklies up 8.46%, and XLF on the weeklies up 13.07%. So those are last week's trades. Pretty good. And again, the winners big, the losers small. The winners, I'm staying in them. The losers, I'm getting out quickly. And that's exactly what I showed you. All right, let's talk a little bit about trader psychology before we move on to taking a look at potential trades for next week. This is from Tony Stark over on on Twitter, excuse me, and he's quoting Shane Parrish. I don't know Shane, at Shane A. Parrish. I like his post though. 90% of success can be boiled down to consistently doing the obvious thing for an uncommonly long period of time without convincing yourself that you're smarter than you are. Okay, well, this can be applied to a lot of things, but let's apply it to trading. 90% of success in trading can be boiled down to consistently doing the obvious thing for an uncommonly long period of time. What is the obvious thing? The obvious thing is having a trading plan, having a process that you just follow like a robot over and over and over, and consistently doing that. You're going to go through periods where you have drawdowns in your account. It's unavoidable, but 90% of success can be boiled down to consistently following your trading process for an uncommonly long period of time without convincing yourself that you're smarter than you are. What does this part mean? It means following your process without thinking that you're smarter than the market and that you can make some kind of adjustment to your trades that's not in line with your process. It's pretty easy, everyone. If you're having a drawdown, if you're having a difficult time trading, I would really advise you, start over, get yourself a good trading process, follow that trading process, because in the long run, everyone, that is what's going to make you a profitable trader. Not thinking, hey, the market shouldn't be here or the market shouldn't be doing this. If it's doing it, it's doing it. That's all that matters. And if you have a trading process that you're following that lets things run regardless of what you think of the market. I mean, me personally right now, I have no idea why the market's up here. It doesn't make any sense. It seems to defy physics of economics, to be honest with you. But that's just me. That's my view on the market. If it were up to me, I would be shorting everything here, but I'm not. I have potential shorts that I'm going to show you that I'm looking for, but they're not based upon my opinion. They're based upon actual setups of trading principles. All right. So basically, get yourself a process, do it over and over, super boring, like a robot, a process that uses good trading principles, and just keep doing it over and over and over and over again. All right. All right. Okay, so here we are. I have 7 potential trades that I'm looking at potentially next week, both to the long side and to the short side. I might want to mention right now that, there's a potential that these all could trigger on the same day. Does that mean I would take all 7 of these? No. Um, I have a rule in my trading that I only take one trade per day per time frame. Well, one trade on the daily, one trade, on weekly bars. And like I said, these could all trigger, theoretically on one day, but I'm going to take the best trade. And what makes the best trade of the day? The one basically that has the highest score. What does that mean? Well, if one has one signal and another has 2 signals, then I'm obviously going to pick the one that has 2 signals. If one has 3 signals, I'm going to take that over the one that has 2 or 1, right? And so I look at the multitude of and confluence combination of signals. I also look at what is going on the higher time frame. That factors into the equation. Risk to reward ratio also factors into the equation. Relative strength of that particular market also factors into the equation. So I just want to be clear that if all 7 of these triggered on the same day, I would still only take one. I would take the one that had the best report card, right? And again, this in my private one-on-one lessons, this is what I teach you to do, is to narrow it down to the very best one. So this is Budweiser. Unbelievable rocket ship to the moon here. Unreal. Unreal. But here, over on the 4th of May, is an order block. An order block, the negative order block, is where you have an up bar that the highest up bar before the structure break. Here we had a level of liquidity. We ran the level. We broke the level to the downside. This puts us into a bearish market structure, which it certainly did. But I look for an up bar before the structure break to the downside. And in the future, regardless of how long it is in the future, if it gets back up into this order block anywhere between here, 64.80, 66.23 is the range of this order block, that is a potential short. So we're not there yet, 64.80 to 66.32, but next week, if we on a day get in anywhere into this order block, I will consider taking the trade. I'll position size correctly. My end of day stop will be a close over the high of the order block. And then of course I'll have my 2 ATR trailing emergency stop level up here as well. So potential for next week on Budweiser, if we reject 64.80 or we're anywhere in the middle of this order block, all the way up to 66.32, basically anywhere between these 2 green lines, that will be a potential short for me on Budweiser. All right, here is diamonds. Now I did take a short that was a losing trade on short. I'm going to clean this all up here. We're going to have to go all the way back. Oh no. Here we go. Here's an order block here as well. Level of liquidity, we ran it, we changed structure to the downside. So just like Budweiser, potential order block here and here. So potential short between 355.10 and 356.80. So basically next week, if we touch that line, that's potential, or anywhere in between here, this is going to be potential short order block. My stop would just be a close over the high. My end of day stop would be a close over the high of that order block. So I hope that makes sense. And hey, by the way, everyone, if you're enjoying the podcast today, if you're learning something valuable, and I hope you are, I would appreciate it if you could just hit the thumbs up button. It really does help out the channel. It lets YouTube know that there's people are interested in the channel, interested in the content. So if you are enjoying something and find it valuable, I would really appreciate it if you would subscribe and or hit the like button. I really would thank you for that. So on Diamond here, here's the order block, short between 355.10 and 356.80 potentially for next week. Russell 2000 IWM, also a potential short. What is my signal? Well, back here on the 15th, we got up to the 200-day moving average. Now, when you're shorting, it's always advisable to short a lower high rather than a higher high, unless it's an order block. When you're going long, it's more advisable to buy higher lows than it is lower lows. So conversely, if you're shorting, a lower high is better. Well, here we have a high. It rejected that 200-day pretty substantially and moved back down. Now we're coming back in. Look at this confluence here. We have a 300, a 200, 250, 100-day moving average right in here. And it doesn't have to be exactly the 200-day moving average, although the 200 does make sense. But right in here looks like a very interesting place to short because it's still going to be a lower high compared to this high, and there's significant resistance here. 300, 250, 300, 200, 250, and 100 here. I will just go ahead and say if we reject either the 300 or the 200, that would be a potential short for me. Position size, place my emergency stop above. And let's just say it's the 200-day moving average. If Monday it goes up, rejects it, closes back below, I'll get short. Position size quickly, 1.5 ATR trailing stop level below, 2 ATR emergency stop above. And then if it just simply closes above the 200, well, I'm just out. That's it. So IWM also looking at potential short. NVIDIA, also a potential short, and I'll explain why. So NVIDIA last week had outstanding earnings, just the best earnings ever. But what happened? Stock went down. That's telling you something. That's telling you when you have great earnings, but the stock goes down, that it was baked into the cake, that probably it is already fairly priced and people were expecting that. So what happened here? Well, interesting what happened here. We have a level of liquidity here. We ran the level of liquidity here on the 20th. And then on Wednesday, we came down, closed below the first pivot point. This is a market structure. NVIDIA just changed to the downside. Level of liquidity here on the 15th. We ran it on the 20th. And then on the 22nd, we took out the first pivot point to the downside. This changes the structure, at least temporarily, to the downside. So when this happens, I'm looking for a fair value gap, and you can see there's the low of the 21st and the high of the 24th. There's this little gap here that never got filled. If we get back into this gap, I will consider a short. And this is taught by ICT, fair value gaps. You can look it up on YouTube. Really, really good, great stuff. And I've incorporated it into my trading as well. But everything, we checked all the boxes. Level of liquidity, we ran the level of liquidity, we changed market structure to the downside. Now there is this gap here. According to ICT, this is the short area. So if we get into this area, I'll consider taking the short. My end of day stop would just be simply a close above this high here. Place my emergency stop here above. There's some range here, so I may, instead of using a 2 ATR, use a 3 ATR, but considering to get short NVIDIA here between 891.21 and, I'm sorry, 489.21 and 492 next week, potentially. Pfizer, all right, potential long. Okay, so Pfizer had a nice double bottom bullish divergence. And by the way, this is another strategy that I teach in my one-on-one course. You know, I studied one-on-one with Dr. Alexander Elder. He uses double bottoms bullish divergences. He thinks it's the strongest technical indicator in technical analysis, and I would have to agree with him. It is very strong, just that they don't happen all the time. But I'll just kind of take you through this. You see this low area that we have here? You see how deep the red bars are? This means there's a lot of selling momentum. Then we rally into green, which you need. But then here, we went lower than this low. But you see how the MACD bars are red? They're very shallow compared to over here. All this means is that the momentum to the downside is running out, and very likely if you run out of sellers, if you're running out of downward momentum, you're going to move up. Well, look what happened. Presto changeo, double bottom bullish divergence, and that's exactly what happened. Now, am I going to buy it here? No, it seems a bit chasey to me. But what I'm looking for is what's called a higher low V1 or V2. And again, this is what I teach them. One of the strategies that I teach in my one-on-one courses, one of my absolute favorite strategies. You have to close below the value zone. The value zone's this green, anywhere between this green line and this green line. You have to close below it, which we did. You have to come into the value zone, which we did. Now, all I need is a bit of a pullback and then look for a higher low V1, V2. And that is the leg that usually will trend. When you come from a lower low outside of the value zone, you tend to do what it's doing, but then it tends to kind of come back and backfill a little bit before the move up. So what I'm looking for next week is a pullback and a higher low V1, V2. Again, if you don't know what a higher low V1, V2 is, check out my video on YouTube. That will explain it there. I think that video is about an hour, and I talk specifically about V1s and V2s. So potential for next week for Pfizer is a pullback and then a higher low V1, V2. And, you know, Kerry Lavorne is the man that developed the higher low V1s, V2s, and I studied with him for years. And, you know, I asked him one day, I said, what is your absolute AAA rated trade? And he said, oh, that's easy. That's a higher low V1 or V2 in the value zone after a double bottom bullish divergence has formed. We have the double bottom bullish divergence. That's out of the way. Now if we get a pullback and a higher low V1, V2, that is his absolute AAA rated trade, and that is what I am waiting for. Walgreens, WBA, higher low V1, V2. We closed below the value zone. We came into the value zone. We've pulled back. Now if I get a V1 or a V2 next week, a higher low V1 or V2, I would take the trade. For example, Monday. Monday would have to go below Friday's low and then close above Friday's close. That would be a higher low V1 or V2. You can see the long positions that I'm looking for are not the ones like the SPY and the Qs and all that kind of stuff at the very top. In my opinion, those are very much extended at the moment. A lot of FOMO, people buying. There's no way I'm buying that. You know, I bought the SPY way down low when it was at a reasonable price. So the longs that I'm looking for here at the moment are reasonable. They're in the value zone or below the value zone. So I'd be very careful about chasing this market, the Magnificent Seven and the indexes. I'd be very careful about chasing these up because in my opinion, most of the move has probably already happened. So that's why the trades that I'm looking for to the long side are down at a reasonable level. Okay, so close below the value zone, in the value zone, pulling back, sideways motion here. Next week, if we have a V1 or a V2 on WBA, I will consider taking that trade. Walmart, again, good example here of why not to hold through earnings. I never hold through earnings. Why? Because of this. I mean, look, here on the 15th, we were way high, up at the third ATR channel, by the way. Never going to buy up here. And I'm never going to hold through earnings because regardless of whether the earnings are good, bad, you never know what's going to happen. And look what happened. Bam. So as far as what I'm looking for next week on Walmart, 200-day moving average, very, very simple. Next week, if we go down, bounce at the 200-day moving average, if we have an intraday rejection of the 200-day moving average, or if we close below the 200 and then close back above the 200, giving me a good risk to reward ratio, I would consider getting long Walmart. All right, so let's do a quick review. I don't think I've ever had so many shorts on this channel. Anheuser-Busch, Budweiser, looking for a potential short inside this order block here between 64.80, 66.32, potential short in this area. DIA, Dow Jones, also looking for potential short inside the order block between 355.10, 356.80. Russell 2000, looking for potential short with next week of a rejection, a lower high rejection of the 200-day moving average. NVIDIA, we change market structure to the downside, potential short if we rally back up to 489.21 up to 492. So those are the four shorts. Pfizer, if I get a next week or in the future, get a higher low V1, V2. Walgreens, looking for to get long, higher low V1, V2. And Walmart, looking for a rejection of the 200-day moving average. All right, so those are the dailies. Let's head over on the weeklies. Now remember, weeklies, these happen on Friday. So Friday's close. Okay, here we go. BRKB, this is Berkshire Hathaway. Here is an order block. This was the highest close before the structure break, level of liquidity. We ran the structure, or we ran the liquidity. We had a big move down below the first pivot low. This changed the market structure to the downside. And so next week, potential short on the weeklies between 364.40 and 370.90. If it rejects this or closes anywhere inside of this order block, I would consider getting short BRKB. FXY is the Japanese yen. Japanese yen did have, you can see we've been going down, 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 down for a long time. You can see the lows here, the very deep red MACD bars, and then we rallied. On these double bottom bullish divergences, you have to rally into green. Yes, we did get some green now. So now I am waiting for a pullback to test these prior lows, but I can already tell just from experience, if we do move down, test these prior lows, we are not going to have as much red. We may not even have any red. That would give a beautiful double bottom bullish divergence or a double bottom bullish divergence with the missing right shoulder. Missing right shoulder is when you have no red. So even if you have a double bottom bullish divergence or a double bottom bullish divergence with the missing right shoulder, you still need a trigger. Well, the trigger would be an under 30 over 30. We're at 35.78 right now. So next week, don't know if it's going to happen. If it doesn't happen, I'm not going to take the trade. But if it does happen, I'll consider taking the trade. Is if we go down, test these previous lows, reject the 30 RSI on a weekly basis, we'd have a rejection of the 30 RSI with a double bottom bullish divergence. That would be a very good risk to reward ratio. Meta. Well, well, well. So over the past 5-10 minutes, I've been talking a lot about double bottoms, bullish divergences. Well, let's talk about double bottom bearish, double tops bearish divergences. And Meta jumps out. To me, it just jumps off the screen. Again, I told you I studied one-on-one with Dr. Alexander Elder. If Dr. Alexander Elder saw this chart right now, he would probably be salivating, as long as a few things happen. Take a look at this. Here is Meta. Look at the high here on the 28th. You see how high these green MACD bars are? A lot of buying momentum, a lot of upward momentum, clearly. Then we pulled back to red, which you have to do with this strategy. Now look, are we higher now than we were over here? Absolutely we are. Look, no green whatsoever. This is called a double top bearish divergence. Lots of buying here, pullback. Yes, of course we've been moving up, but from a MACD perspective, the buying is drying up from a MACD perspective. If buying dries up, what's the implication? The implication is that you are going to move down. So this really, really, really jumps out to me as this is getting very, very toppy. Let me show you another thing too. Look at the ATR channels. Here's the 1, here's the 2, here's the 3, 4, 5, 6. At this high, we got to the 4th ATR channel. Now we are much higher. We're at 1.5. We're at 1.5 here. We were 4 here. This is called an ATR divergence. Let's look at another divergence. RSI. Here on this high on the 28th, look how high the RSI was. Down here. Now we're higher. RSI is way down here. This is a triple negative convergence going on. This is the trifecta of negative convergences. MACD, RSI, ATR. In my opinion, this is going down. But I still need to have a trigger. Technically, you could have taken the trigger on Friday because we closed under the 70 RSI. Technically, that would have been a legitimate trade right on Friday. But what I'm looking for next week is a V2 to the downside to get me in the trade. V2 consists of 3 bars. Bar 1. Bar 2 has to go above the high of bar 1, which it has. Next week, if we close below the close of bar 1, which is 335.04, if we close below 335.04, we will have a legitimate V2 entry trigger to the downside. So that is what I am looking for right now. Because of the double tops, bearish divergences with the MACD, the RSI, the ATR channels, this is primed to go down, but I still need a legitimate trigger. My trigger would be a V2 to the downside. Of course, I'd have to position size properly, place my emergency stop above, so forth and so on. But this really jumps out. And when I studied with Dr. Alexander Elder, he's like, Greg, when you're looking for a setup, it really has to jump off the screen at you and grab you by the face. This does that to me. All right. Pfizer. Talked about Pfizer already on the daily, but on the weekly, we're at 34.96. We've already gone under 30 over here. If and only if next week we come back, move back down, go under 30 over 30, that would be a higher low under 30 over 30. Higher low, anything is better than lower low. So don't know if it's going to happen or not, but if it does, head back down on the weekly bars and go under 30 over 30, I would consider taking the trade. VIX, okay, talked about VIX before. A lot of things going on here. This looks horrible. But from a MACD perspective, an RSI perspective, an ATR perspective, it looks very strong. I know it's counterintuitive. Look, over here at these lows, we have red. Then we rallied. We are lower now here than we were over here. No red. That's a double bottom bullish divergence, missing right shoulder. That's bullish. Let's look at the low over here. We were at the negative 3rd ATR channel. Now we're lower. We're only at the negative 2 ATR channel. Let's look at the RSI. RSI at this low, way down here. Now we're lower over here. RSI is higher. Just like I showed you on Meta with the triple bearish divergences, VIX has triple bullish divergences. But even though those divergences are still in place now, I still need to have a trigger. What's the trigger? Well, look, we're at 29.68 on the RSI. Next week, if we close over the 30 RSI, I will consider getting long VIX because of the triple divergences, but I still need the trigger. under 30 over 30. We're at 29.68. If it moves up at all next week, very easily we could close over the 30 RSI. And this is why I'm telling you to be careful about the market, and that I think the market's near at least a short-term top because of what the VIX is showing me here on the weekly charts. Last but not least, WBA. Here we have a low, deep red MACD bars. We've rallied into some green. I'm looking for a move down, test of the previous lows, under 30, over 30. That would give us a double bottom bullish divergence, but still need the trigger of an under 30, over 30. And again, these stocks here, Walgreens, is not up at the 6 ATR channel, right? I'm never going to buy up here. These are reasonable levels to get long. Doesn't mean they're going to be positive, the positive trade, but they're reasonable levels to get long, especially with the technical indicators of if we do come down, test this low and go under. If we go under 30, over 30, we are definitely going to test that low and we'll have a double bottom bullish divergence. All right. So real quick recap. Looking for potential short on Berkshire Hathaway in the order block on the weekly between 364.40, 370.90. FXY, Japanese yen, looking for a test of the low and an under 30, over 30 with a double bottom bullish divergence. Meta, triple bearish divergences, looking for a V2 entry or a close below 335.04 on Friday. Pfizer, looking for a retest, looking for a higher low under 30, over 30 on the weekly. VIX, triple bullish divergences, looking for a close over the 30 RSI. And WBA, looking for a retest at the bottom and a retest of the rejection of the 30 RSI with the double bottom bullish divergence. So those are what I have on the daily and the weeklies. Hope this was helpful for you, everyone. Like I said, I do teach private one-on-one lessons in the evening time via Skype. It's a great course. It's a 15-hour course. I think the best way to learn anything is one-on-one with an instructor, with a qualified, experienced instructor, and that's what I do in this course. 5 sessions, each session's 3 hours. That's where you get your 15 hours. We usually do 1 session per week, so it takes 5 weeks to do the course. But once you're done with the course, you will learn. You will have a skill in trading that will help you the rest of your life. The course does cost $1,750, but it's worth every penny. I promise you. All you have to do to get it started, just send me an email, and then we can write back and forth, and we'll set up a meeting, and we can talk about the course and the format and all that kind of stuff. But I would highly suggest and recommend that you take this course. You will be a better trader. And like that, I have trained people that are absolute beginners all the way up to very, very seasoned hedge fund managers. And they've all been glad that they've taken the course from the feedback they've given me. Now, if you're not in the financial position to do the one-on-one course, I have a really good alternative. On udemy.com, I have a course called the Deep Dip Buy Stock Trading Strategy. Such a great course that only costs between $12 and $15, and I take you through that strategy step by step. The course is 9.5 hours long, 26 videos, 15 study guides. I've sold so many of those courses all over the world and have such good reviews, such good feedback. I think I have 4.9% stars on that particular one. So that is a really good place to start as well. And as I mentioned, if you wouldn't mind hitting the thumbs up button, it really would help the channel. And most importantly, I like to always leave everyone off with this. Please try to go out and do something nice for another human being today. If we all did one nice thing for another human being, it would just make the world a better place. If you could also go out, try to do one nice thing for an animal, that would be great as well. They appreciate acts of kindness just like I do. Just imagine what kind of world we'd have if everybody did a nice thing every day for a human and an animal. And I think this world could definitely use that. So I hope you had a really good holiday. I hope you have a good weekend. I appreciate you being here. I appreciate investing the time, and I hope it's helpful. And God willing, I will see you next week. And thanks again for being here, and enjoy the rest of your weekend. And then on the way out here, I have to run the U.S. legal disclaimer. Thanks, everyone. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast produced by Gossett Trading and Mentoring LLC is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.